Hey guys, welcome to the Altius Research live stream. Um, got a couple things we're going to go over today. We'll cover everything that went on in the markets this week and then the everything crash. That's what I'm calling it. So we'll go over that. I launched a channel on YouTube if you want to watch on there, if it's easier. It's just Altius Research, Altius Research. Okay, so I wanted to start with actually, before we even do that, I sent out an email a couple days ago or yesterday for my latest research report, and that was on Velo 3D. They're a metal 3D printing company that scales production of specialty parts for defense and aerospace. I posted it on my Twitter, so you could find it there. Um, or you can just sign up to the Altius Research newsletter, which is completely free. And I just send out my highest conviction ideas. This is not financial advice, just ideas. Okay, so let's get into the everything crash. So I had a tweet yesterday that went pretty viral. So I'm just going to start by reading that, and then we'll break it down and go over some charts, and I'll show you exactly what's happening. So I'm a day trader and long-term investor, so I follow every tick of the markets every day. So it's okay if you're not. I'll try to explain it in a way for long-term, medium-term, short-term investors for everybody. So I won't leave anybody out of the conversation. I'll try my best to keep it beginner level. Okay, so the everything crash. Normally, when the stock market goes down, the bond market goes up. This provides stability to the average investor's portfolio. However, due to the war in Iran, oil prices are rising, causing inflation to rise. As a result, the Fed can't cut interest rates. They are now pricing in interest rate raises, which in turn leads to lower bond prices and higher bond yields. Because investors are now anticipating higher bond yields in the future, this makes debt more expensive, increasing the cost of capital, which has a negative effect on future growth projections. On top of all this, precious metals are selling off because central banks are trading gold and silver for oil. This has created a situation where stocks, bonds, and precious metals are all crashing, while bond yields and inflation are increasing. Soon, GDP forecasts will have to be slashed, and corporate revenue and earnings projections will have to be reduced. In my 15-year investment career, this is the worst macroeconomic backdrop I have ever seen. So that was the tweet. And we're basically just doing this live stream today to break it down and explain each one of those individually. You know, we've been talking about this for like 2 weeks now, and it's played out exactly as we anticipated it would. So let's get into some of the charts here. So this is the QQQ here. This is NASDAQ, the ETF for the NASDAQ. And I normally just use the NASDAQ ETF because so much of the market is concentrated in technology stocks that it just sort of makes sense to stick to that. And if we could interchange it with S&P 500 SPY, it's a pretty similar looking chart anyway. So the last stream we were just breaking below the 200-day moving average here. That's the red line here. Let me switch into presenter mode here. Give me a second here. Okay, there we go. Yeah, so you can see here's this red line here is the 200-day moving average, and we sliced right through it, and now we're sort of entering a free fall situation. Like, well, if we wanted to bounce higher, we would have wanted them to hold this 200-day, but we came right under it, and now we're starting to enter this free fall situation. If you look at the volume profile down here, you can see just all this red volume. It's like net volume selling. And we talked about this last time too. What you want to see are like capitulation wicks like this. If you go back to this November sell-off, you can see there's a huge sell candle here where that was the peak volume capitulation. And then we started to rally after that. So sort of what that means, let's break down into like an hourly time frame here. What that means really is that the sell-off has been pretty orderly so far. So you can see, I mean, we're coming down pretty sharply the last 2 days, but it really has been orderly so far, and that's concerning um, for a number of reasons because you really just haven't seen capitulation yet. I mean, we are reaching the August lows right now. If you see over here, this is the same level where we're at there, but it definitely looks like we could continue lower. And until we see that capitulation wick, I would anticipate that we continue lower. But that doesn't mean there won't be bounces in the short term. So really what we'll be looking at next is this green line is the 9-day moving average. So it wouldn't surprise me if Monday or Tuesday we sort of bounce upward as that moving average comes down and start to hit it like somewhere around here. But then we're gonna need good geopolitical news to continue higher from there. Otherwise, we could just be retesting some of these moving averages and then just rejecting them to continue down lower. So I think we're really going to need a resolution to the crisis or to the war in Iran for that to happen, and it just doesn't seem like that's likely. So, as I said, it could be short-term bounces, but look for it to continue lower. Um, so that's the Nasdaq, and then it's basically the same story for the S&P 500. Similar chart, pretty much the same story there. So let's break down the tweet a little bit. Okay, so the first part of the equation here is that the stock market is selling off, as we just demonstrated. The reason it's selling off, at least in part, is because of the war in Iran. But really, what that is that's caused by oil trading higher. And this is a chart of light crude oil futures. So as you can see here, the last like 2 weeks, 3 weeks, we've just seen an incredible rise in oil prices. And we started to back off a little bit earlier in the week here, but then as we got later into the week, it started to skyrocket again. And now we're basically sitting at the highs, and this thing looks like it's ready to break out higher. So if oil does break out higher, like we sold off the highs, came off the lows, and now we're sort of just sitting in the middle, but towards the top of this range here. If we break out of this range, that could be where we see the capitulation wick on the equity markets. So I would keep an eye for that. But going into Monday, this chart looks horrendous. This looks horrible. Like it looks like oil's going to fly. And that will, or that is presumed to coincide with what looks to be the start of a U.S. ground invasion and escalations in Iran. So that's something to keep an eye on. Yeah, so that's oil. And oil leads into the next problem, which is the bond market here. So let's look at 10-year government bonds. Okay, this is the U.S. 10-year yield. So typically what happens when the equity markets go down is that there's a flight to safety, if you've heard that phrase. And what that means is that investors sell their stocks and they start buying bonds. But in this case, this time it's different because oil is going up. That creates an inflation problem because oil is a core component of the CPI, which is like the inflation index that the Fed uses. And if there's higher inflation being anticipated, obviously in this case directly due to oil prices, then that handcuffs the Fed and they're not going to be able to cut rates. So, and then if the Fed can't cut rates, then that drives bond prices lower and bond yields higher. So that's sort of this unique situation where we've got this pullback where both the stock market and the bond market is going down. So bond prices and bond yields are inversely correlated to each other. So we're just looking at yields here. So yields have spiked up. So President Trump has been talking about how he wants to lower yields, and So yields were lowest before the war here, February 26th. That's literally the day before the war, 2 days before the war started, and we were under 4%. But since then, bond yields have just ripped higher, almost all the way up to 4.5%. So that's like a 10% move in bond yields in like 2 weeks, which is absolutely crazy. Um, so yeah, we've got yields screaming higher, even corporate debt. So corporate. So this isn't yield. This is the price of corporate debt, corporate bond yields, or corporate bonds, going lower here in unison with the stock market, which is it's truly a unique scenario. At least I can't think of any that have happened before, but investors who have been longer in the markets than I have probably have some examples of this, whereas this has happened before, and it would be actually interesting to go back and research some of that and see how that was resolved. But yeah, so the reason that this is important is because the higher bond yields go, the more expensive it becomes for corporations and governments to finance debt. So another thing President Trump talks a lot about is the national debt. And I mean, when rates are screaming higher, that just makes every dollar that the US government has to borrow to finance its operations, including the new war, even more expensive than it was before. So that's what's going on in the bond market. And then we could let's go to the Fed watch tool here to see exactly what's happened. So the current target rate at the Fed is 3.5 to 3.75, or 350 basis points to 375 basis points. And that basically means that the Fed lends the big banks dollars, I think it's in the overnight rate, at 3.5% to 3.75%. So then the interest rate that you pay when you borrow from a bank has to be something in excess of that 3.5 to 3.75%, so that the banks can make a margin on that. So we're looking at what's priced into the bond market by the Fed here for the next Fed meeting, which is April 29th. So there's a 96% chance that rates will stay the same the next meeting. And then there's a 4.1% chance that they will actually raise rates next meeting. So that's pretty low. So it's fairly consensus that the current target rate is going to stay the same as what it is right now. But if you let's go out to October. Now, what's happened is that there's a 23% chance that the Fed actually raises rates. And this whole chart has flip-flopped just in the last 4 weeks since the war started. Previously, it was being priced in that the Fed would actually cut rates. But now it's changed to where interest rate raises are starting to be priced into the bond market. And that's why these bond charts look like this. Because if they anticipate that that rates will be higher in the future, that means that there will be less demand for bonds issued now, which drives the price of the bonds down and then rates higher. So if you think about it just in pure supply and demand terms, if somebody was going to lend you money, they would have to charge a higher interest rate they would have to pay you a higher interest rate to get you to buy the bonds now, as opposed to later, because you're anticipating that later the rates will be higher. I hope that makes sense. So that's the bond situation. So let's get into stocks, because it's directly related to that. So because it costs more money, like because the cost of capital is increasing, that basically means that it increases the price. It increases the financing costs for corporations. So I've seen a couple posts on social media of people talking about how cheap Microsoft and Meta and like some other of these big tech companies are. And you can see, I mean, they've sold off viciously from the highs this year. I mean, when was this? Okay, so October of last year, Microsoft was all the way up at $554, and it's trading at $356 now. I mean, that's an incredible sell-off. And again, if you look at the weekly here, It's come below the 200-day weekly average, and it hasn't broken that. I mean, I guess it technically tested it in November of 22, but I mean, you have to go back years to see the last time it did that, and it looks bad. Uh, I mean, you could hope that it holds this level here. So maybe we'll hold this level and then start to continue higher. But you ultimately need to see it start to reclaim some of these averages. So you need to see it break above the 200 week, maybe retest it to the downside, and then start breaking through some of these other ones to get the moving average underneath them, because then they sort of act as a price support. And people like to downplay technical analysis, but the truth is that a lot of great, even long-term investors use it. Charlie Munger is very famous for using the 200-week moving average. He loves to buy things that are at the around the 200-week moving average. So maybe if he were alive, he'd be looking at Microsoft today. But so the idea that these are cheap, that's what I want to look into here. So we could look into the forecast here. So Microsoft is currently trading at $356. So let's go into the EPS for Microsoft here. So for the year of 2026, it's estimating it's going to make $16.50 in profit. So that would put it at about a 22 price to earnings ratio, and that's about average for all-time NASDAQ companies. But historically for Microsoft, that's considered low, right? But then it gets interesting where when you look out to like 2028, where the EPS is like 22.50 a share. So 22.50 a share, I mean, that's under 15. That's under 15 price to earnings ratio. So that's very low if you're expecting this kind of growth. But the issue that we're going to see, and let's do Meta also. So Meta is trading at 525, and then it's about $30 EPS for this year. That would put it at about like 18 PE. So that would be considered very low for a growing technology company, hyperscaler like Meta. And it's even lower if you look out from like 2028, if it's expecting $40 a share. I mean, that's like 13 PE from 2028. But the thing you have to realize, or the thing that you have to understand about this, is that although it looks like these PE ratios and valuations are low, considering future earnings, you have to understand that at any point these companies can start cutting their forward guidance. So they can start cutting these EPS and revenue projections here. And the reason they would have to do that is something like what we're seeing now, where oil is really expensive, or if they're unable to procure certain materials from suppliers or to produce themselves, they might have to start cutting their revenue and earnings expectations. And the longer this war in Iran goes on, the more likely that becomes. So it could be deceiving when you look at some of these companies and somebody says, oh, they're valued really low right now. Like, now's the time to buy. But what's actually happening is that the market is pricing in lower earnings expectations going forward, even if they haven't been formally announced yet. So like at any point, Meta could cut their earnings estimates for next year by 25%, and that would radically affect the valuation of the company and the future earnings projections, obviously. So that is something to watch out for. I mean, if some of these companies, especially the hyperscalers, if they started cutting their forecasts, that would be a huge red flag. And I mean, at that point, you're almost certainly looking at a recession, despite the additional government spending that would go towards financing the war. So that's something you really want to look out for. And I mean, you would think that that's something that President Trump is aware of and would not want to see happen. And at that point, you would think he would be looking for a way to alleviate this conflict and get out of it. Unless he's just entrenched in it for other reasons. I guess that we won't get into too much here. But okay, so that was a look at just a couple of the hyperscalers and how they're reacting. But let's also look at precious metals. So let's just do GLD to keep it easy here. This is the gold ETF, and this is a really interesting dynamic and sort of wrinkle in the current crisis is that sort of like what's going on is normally, like I said before, you would get a flight to safety out of stocks and into things like bonds and precious metals. But even gold and silver are selling off. So that's gold. I'll show you SLV, which is the ETF for silver. Similar looking chart. Let's go back to gold here. So yeah, so you can see there's just been a huge sell-off in gold too, just in the last couple of weeks. So from about $500 down to 414. So that's like a 17 or 18% correction just in a couple days, basically, which is just a wild move. But it is true that precious metals have had a crazy run over the last couple months. But yeah, huge sell-off coinciding with the war and the oil crisis. And you know, it's interesting. This is particularly interesting because what's going on is that central banks are effectively trading precious metals. So they're trading gold and silver for oil out of desperation, basically. So, for example, the Turkey central bank sold 58 tons of gold last week. So you've got huge moves happening in the precious metals markets, and again, you're just not seeing the flight to safety. So I think this is actually I think the precious metals are actually an interesting trade if this continues, because at some point there's gonna be a flight to safety, and the silver and gold could rip on that, and it could be the same for bonds too, really. So the longer it goes on, where everything keeps going down, at some point it's going to change, and if you see real fear, you would start to see precious metals and bonds start to increase. So I think that's actually another sign that we actually haven't seen capitulation or extreme fear in the markets yet. Okay, so then I didn't put this in the tweet, but I still want to go over this because I've been talking about it for a couple months now. And this is the private credit situation in the United States. So here's Blackstone, and they're one of the biggest private equity firms in the United States. And basically what that means is they put up private capital to companies that companies take loans from them basically to finance different operations. And they're heavily involved in the AI and data center financing. The private credit companies are. So Blackstone is one of them. And you've just seen a huge sell-off in Blackstone from about 190 down to 108. And that's just really concerning. So that's Blackstone. We can look at KKR, similar chart. And then OWL, I think, is one that is particularly exposed to data centers. And that one has just fallen off a cliff all the way from 27 down to 8. So, I mean, at some point, you're going to have to start to worry about insolvency. I mean, I've seen a couple of the firms halt redemptions where investors are limited to how much money they could pull out of the fund. So that's extremely concerning, and it really wouldn't surprise me at some point if the government has to step in or start to guarantee some of these loans. But that's the private credit situation has been developing for months like this, and it's not getting better. So we'll have to keep an eye on that going forward and see what happens there. And then the last thing that I wanted to look at here was, so that's what's going on in the market. And then in addition to that, we have contracting job numbers now. So total non-farm payroll employment was down by 92,000 jobs in February, and the unemployment rate was level at 4.4%. But the important thing to know about that is if you're looking for work longer than, I think it's 6 months, they just stop counting you. So the unemployment rate is definitely higher than 4.4%. So it's sort of like the number is always it's always being rigged a little bit lower than it actually is, um, perpetually. So that's what the percent. I wouldn't put too much faith into the percentage there, but the important part is that we're down 92,000 jobs in February, and you can see a further breakdown of that here. There you can see again, total non-farm employment change minus 92,000. I think officially they said that some of this was due to strikes, but these are notoriously fake numbers and further revised months later. So I think it's interesting as a signal, but not always the most accurate. But if this is a turning point in the job market where you start to see jobs data start to contract, this could, I mean, this looks like the beginning of some sort of recession or depression or something like that, given the larger macroeconomic backdrop that we sort of just went through there. So I find that concerning. So I would want to keep an eye out for particularly for the next inflation data and employment data, and see where those are at. Yeah. So then let's see. Yeah. So I guess just in terms of thinking, I'm just thinking out loud here a little bit about like what a resolution would look like here. Um, and it's just hard geopolitically to think about where we go from here. I think one of the main things is that the extent of the infrastructure damage throughout the Middle East, like specifically in Bahrain, Qatar, UAE, Kuwait, like we've reached a point now where the last week or so, there's been like the attacks on infrastructure has really ramped up, like specifically in like desalination plants, oil fields, and power infrastructure. So to give you one example, Qatar Energy had their main facility attacked. Had their main facility attacked last week, and I think they said that they were going to have to basically default on like 3 to 5 years of like promised contracts for production, which is crazy. Um, and then as a result of that, Cheniere Energy, which is the biggest U.S. LNG production facility, I think they shot up, like you can see here, it was like 20% in one day when that happened. So like the other issue here is you can see that U.S. Not only the military industrial companies and defense companies, but also oil and natural gas are benefiting massively from this conflict. So the point is that there's corporate interests in the United States that are very supportive of this war, and they don't want it to stop. Uh, and then the other thing with some of the destruction of the infrastructure in the Middle East is that these Gulf countries will be less likely to agree to some sort of short-term deal that Trump might be tempted with to get out of the situation at this point. Like some of these Gulf countries are going to want a final solution to the Iranian threat after incurring such large-scale infrastructure damage. So, like if Qatar Energy loses 20% of its production capacity for the next 5 years, I mean, they're not going to want to hear that Trump made a deal with the same Iranian regime, the same people are in power, because they're going to have to worry about future attacks. And at this point, they've lost so much that I don't think it's likely that they're going to be amenable to that type of deal, which suggests that this conflict can be drawn out even longer than Trump has said and than was initially anticipated. With that said, though, it's important to know that this whole situation can reverse at any moment. I mean, if we've learned anything through President Trump's presidency, it's sort of that he can change his mind instantly, and there could be ways out that we're not quite imagining. So I think that is something that you do have to be prepared for at any moment, is that this whole thing can just reverse. Like I don't want to paint it as doom and gloom, as if everything is going to crash forever and the market's going to zero and we're going to be in a recession. Like that's not what I'm saying. But if it continues this way, This really is like an everything crash though currently, where stocks are going down, oil's going up, bonds are going down, rates are going up, precious metals are going down. Like this is a really bad situation on a macroeconomic level, and it really does need to be resolved quickly. Because even at this point, I mean, even if they signed a new deal, let's say they signed a deal today. I mean, oil prices have already been elevated for almost a month. And then just due to the amount of infrastructure damage in the Middle East at some of these oil facilities, I would imagine oil is going to stay elevated for at least a couple months. And that's just if it was resolved today. So imagine this goes on for a couple more months. Imagine oil's like at these high levels, at elevated levels for multiple months. I mean, like I showed, some of these companies are going to have to start cutting their earnings projections and their forward guidance. And then at that point, these valuations don't look so cheap anymore. They actually start to look quite expensive, and that could happen overnight when they change their forward guidance. So I would be wary of anybody telling you that some of these stocks are cheap. I mean, especially after they've run so much. I mean, let's look at Meta. I mean, just a couple of years ago in 2023, Meta was under $100. So it's up, it's still up 5x just from 2023. So it could go down a lot further. And then, yeah, I mean, I guess the last thing that I'll leave you with is sort of, I mean, to me, this is the most concerning thing that we were looking at is this oil daily chart looks like it's going to break out higher. And if oil breaks out higher, the NASDAQ and SPY are going to break down lower. And it's going to be ugly when that happens, but that might provide one of these capitulation candles that we've been looking for. And then that could be a signal to go long. So yeah, it really is the everything crash at this point. And we need to see some stabilization soon. Otherwise, I would expect it to just continue. Okay, we will leave it there. Yeah, I've got a couple more companies I'm looking at for individual research reports. So if you sign up to the Altius Research newsletter, it's just Altius, Altius research.com. It's completely free. I just send out my highest conviction plays, and I only send out things that are like I'm invested in that are my highest conviction ideas. And then also check out on YouTube, Altius Research. Just search it there. We've got the YouTube channel going now. I know it's easier to watch there than on X. Okay, that's it, guys. Have a good weekend.